Take a closer look at Chevron, that's doubling down on shale, announcing it's buying rival PDC Energy in a $6.3 billion all-stock deal. It values PDC at $72 a share, premium of 10% to Friday's closing price. It's going to boost Chevron's output by 240,000 barrels a day and its footprint in U.S. oil and gas. Chevron down slightly on the news. Here to help us trade that stock, Eva Ados, Chief Operations Officer at ER Shares. Eva, spill the details on Chevron. Do you like it? Do you sell it? Do you hold it? What?
I hold it, and I have mixed feelings for this one because on the one hand, I do not like the category anymore. I think we are seeing a rotation out of oil and energy into tech and growth as long-term interest rates are coming down, long-duration assets benefit, and I think this rotation will continue. But now for the investor who wants to have an exposure into oil, Chevron is not a bad company to own. In fact, it has the best net income margin in its category. When it looks to its, and when you look at its margins, they're above average, and I think they're cutting down costs. And I'm really surprised with the reaction today, even though they're paying 11% premium. I think Chevron has demonstrated over the years that they have been efficient with acquisitions. They are able to incorporate them, and they're cutting down costs. So I think it's mixed feelings for this one. That's why it's a hold.
Hold for Chevron. What about Nike? Biggest loser in the Dow today, down about 3% after Citi analysts put it on negative catalyst watch, and that on the heels of those disappointing results from Foot Locker on Friday. Ava, do you think Foot Locker is going to be a read-through to Nike or no?
I think Nike is a sell. Its relative valuation is 2 to 3 times its peers. If you look at its price to earnings ratio, that's 30 compared to 13 for the average of the category. And now their fundamentals do not look that good. And most importantly, over the years, of the last few years, we have not seen any new exciting growth initiatives. And even though they're piling in on cash, they have actually $10 to $11 billion in cash right now, and that might mean that down the road we might see a new exciting growth opportunity. There's a lot of competition out there. You have smaller companies now entering the market, and so it's a sell.
All right, let's move on to another one that has been doing pretty well, DraftKings.
Yes, DraftKings is a buy. In fact, we've had an overweight on this one in 2023. It's actually helped us a lot with our appreciation of 27% for our large cap fund, and we'll continue to have an overweight on this one because it's a revenue growth story. They have 85% revenue growth compared to 10% for the rest of the category. That's 8 times bigger than the average of their category. And now, and they're entering new markets faster than ever. They're adding new customers faster than ever once they enter a new market. I think that's a disruptive technology. They've been able to increase the pie of sports betting in general. And I think that growth story will continue. So it's a long-term buy for us.
You know, the markets have been performing pretty well, Ava, even in the face of the debt ceiling issue that is looming and either may or may not get. So, are you surprised that the market is as resilient as it has been?
No, I'm actually bullish. I think as we are seeing long-term interest rates coming down, CPI came at 0.4%. Housing, which is the biggest component of the CPI, 30 to 40% of the CPI's housing is going to drop significantly. That's what the Case-Shiller index shows. And there's been a lag of 6 to 12 months between the Case-Shiller index and the CPI. And so once housing is reflected into the CPI, we'll see inflation drop precipitously. That's really good news for the markets, especially when it comes to long-duration assets that get their profits down the road in the future.
All right, Eva, thank you very much for your time today. We appreciate it.